Well, good morning, Jaginder Rana here. The topic for our discussion today is marine cargo insurance. Marine cargo insurance. Let's see what we are going to discuss in marine cargo insurance. Distinguished features, considerations, target segment, nature of transportation, voyage, type of policies, coverage and exclusions, additional coverage, duration clause, terms of sales, marine document, type of losses, cause of losses, claim documents and case studies. So, see what is marine cargo insurance. Insurance of goods in transit by any mode of conveyance is called marine cargo insurance. It could be by water, air, land, post, courier or rail. So other form of insurance have only two parties, insurer and insured. But in marine cargo there are three parties, insured, insurer and carriers. It's freely assignable in interest, rights and goods, and insurance keeps changing. Insurer of interest at the time of loss is must. Additional cover of war risk and strike, right and civil commotion can be opted by payment of additional premium. There is no proposal form. The stamp duty is recoverable from the insured. Marine insurance is governed by various acts like the Carrier Act 1965, Marine Insurance Act 1963, the Merchant and Shipping Act 1953, the Railway Act 1989, the Indian Contract Act 1872, etc. So considerations of marine cargo insurance are that who is the insured and consignee, what is the nature of cargo, packing, voyage, means what is the route, annual turnover, sending limits, season and duration, coverage, previous terms of sales, insurance or claim experience, other terms and conditions like access, franchise and warranties. Marine policy is normally purchased by the importers, exporters, manufacturers, claim handling agents, C&F agents, SHAs, traders, contractors of projects. Nature of transportation against cargo type is there are various methods of packing. Say containerized household goods, leather, gem and jewelry, clothes, packaged food items, spices, tea, coffee, etc. Non-containerized ball bearing, iron rods, metal wires. Bulk cargo means oil, coal, food grains, liquefied petroleum gas, sugar. Heavy machines includes cranes, excavators. Project cargo means turbines, machines to be installed in a manufacturing concern, transformers. Underdeck versus overdeck means when the cargo is shipped under deck, it is usually safe risk against storm, tempest, flood, washing by overboard, rainwater damage as compared to the cargo shipped over deck. Full truckload versus half truckload means if the consignment is sent full truckload it is safe as there are no other type of consignments, while in case where the consignment is for less than full truck and chances of loss increases. Example, household goods like TV, if sent with other goods like iron rods or other customers, iron rods of other customers, the chances of loss to TV sets increases. These are the tank barges which are normally seen for marine cargo purposes. Cautious cargo includes second-hand machinery, fragile cargo, bulk cargo, household goods, hazardous inflammable goods, cargoes, and precious cargo. These are cargo planes which are used for transportation of goods. Voyage means what is the transit or route. For the transit is through Middle East countries like Somalia, Pakistan, Israel. Whether the cargo is shipped under clean bill of lading, if the project cargo or heavy machinery are loaded and unloaded under supervision or not, whether there is route map laid down for the shipment of cargo or not, whether ship or plane, lorry is worthy for the said transit or not, vessel or lorry, plane is, then carrying capacity. There are various type of policies in the marine section. For example, marine specific policy that is used for inland import or export, inland transit and import export. So a single voyage or transit policy, this is for a single voyage. Starting once the consignment is loaded on the vessel at consignor's warehouse, and when the consignment reaches the warehouse of consignee or the destination covered in the policy. Storage covered during the ordinary course of transit and duration clause applicable after the cargo is discharged at the port of destination. Notice of courier or parcel to the insured delivery at the transportation godown or railway yard at the destination town or nearest airport. Service tax not applicable for exporters or exports. Then there is open policy. It is used for inland transit. Annual policy, this is for inland transit where the cover is granted for a full year. The insured has to make payment for full sum insured in advance. Declaration facility for each and every consignment at an agreed date for the cargo in transit from or to his warehouse and vice versa. Then the premium reduces after each and every declaration. Sum insured can be reinstated midst of the policy period at the rates, terms, conditions agreed upon at the time of inception of the policy. So, in the type of policies, other policies are like open cover that is used for import export. So annual policy for import export where the cover is granted for a full year. The insured has to make payment for full sum insured in advance. Declaration facility for each and every consignment at an agreed date for the cargo in transit from or to his warehouse and vice versa. So the premium reduces after each and every declaration, and the sum insured can be reinstated midst of the policy period at the rates, terms, conditions and agreed upon at the time of inception of the policy. Another policy is duty insurance for import policies only, cover provided for imports only. The consignee can cover the actual import duty paid to release the goods. If there is loss to the consignment during the transit from the port of discharge to the consignee warehouse or the destination covered in the policy, the duty lost is also paid along with the loss of cargo. These are the open hatch cargo ships. These are institute cargo clauses. 3 clauses are there, A, B and C. C is the smallest, which covers the 7 risk. That is loss or damage to the subject matter instead insured reasonably attributable to be caused by fire or explosion, vessel or craft being stranded, grounded, sunk or capsized, overturning or derailment of land conveyance, then collision or contact of vessel, craft or conveyance with any external object, then discharge of cargo at a port of distress. Next is general average sacrifice, and 7th is jettison. If clause B is opted, that includes 3 more risks. that is general average and salvage charges, boat to blame clause, washing overboard, earthquake, volcanic eruption or lightning, an entry of sea, lake or river water, and vessel craft hold container. Clause A include 8. General average and salvage charges included in clause C only. If the clause A is taken, that is the biggest one, that includes 2 more risks like total loss of any package, lost overboard, and any other risk not specifically excluded in the policy. So these are the institute cargo clauses. Now overseas transit, general exclusions are there, and these are the vehicle carrier and oil tankers used for transportation of goods. Then comes the institute cargo clauses, minimizing losses. The institute cargo clauses means it is the duty of assured and their servants and agents in respect of loss recoverable hereunder to take such measures as may be reasonable for the purpose of averting or minimizing such loss, and to ensure that all rights against carriers, belly or other third parties are properly preserved and exercised. Then these are the vehicles which are used for carrying the goods through road and through rail. Then comes the inland transit clauses A, B and C. C is the smallest, which covers only 2 risks, fire and lightning. B includes breakage of bridges, collision with or by carrying vehicles, and overturning of the carrying vehicle, and derailment or accidents of light nature to the carrying railway wagon vehicles. Then clause A is the biggest, which also includes any other risk not specifically excluded in the policy or the clauses. So inland transit, rail or road have certain exclusions like willful misconduct, ordinary losses, insufficiency of packing, delay and inherent vice. These are certain additional covers which are available on option under overseas category for import, for export, and for inland purposes also Strike Right and Civil Commission and loading and unloading additional covers are available. These are the LPG carriers, that is how the LPG is transported. This is the duration clause. Cover commences from supplier's warehouse, interior at UK, then port of landing and port of discharge. It terminates whichever shall occur first, delivery at site or delivery at any warehouse, or expiry of 60 or 30 or 7 days after discharge. So this is the duration of cover. Then institute cargo clauses have different durations. These are refrigerated cargo ships and bulk cargo carriers. So duration continues. Duration time limit is like this. Mode of transit by railroad 7 days of arrival at destination, by air 30 days of unloading or destination at destination report, by sea 60 days after discharge from ship, and by post 15 days of notice of arrival of parcel. Sales contract is known as the Incoterms under Sale of Goods Act. When inland transit is involved, prima facie the risk in goods move from seller to buyer at the time of property is transferred. In export import, the transfer of risk and transfer of property are separated. In international sales, the insurable interest depends on terms and nature of Incoterms. Now the question is, who can affect the insurance? Based on the terms of sale, either the purchaser or the seller of the commodity purchases insurance. The term of sale could be C&F, that is cost and freight. Here, buyer's responsibility for covering the risk from seller's warehouse to his own warehouse. And CIF means cost, insurance and freights. Here, seller's responsibility is to cover the risk from his own warehouse to the buyer's warehouse. Then FOB, that is known as free on board, the seller's responsibility for covering the risk is up to the port of loading, and after that the buyer has to cover the risk. Then CIP, seller's risk till the named destination in the policy. And X work, so seller's risk expires once the consignment leaves the warehouse of the seller. These are the marine documents which are required: copy of invoice, bill of lading, packing list, etc. Collision of ships, you can see loss of cargo due to train accident, road accident and breakage of bridge. Then type of losses. In marine there are different kind of losses, like total loss, construction total loss, particular average, general average, fuel and labor charges, forwarding charges. There are all different kind of losses. There could be a number of cause of losses. Means number of perils are there, and the loss can be caused by any of these perils. This is how the goods is loaded. For the claim documents, the documents required are different to other claims. Here, original insurance policy or declaration, original or signed copy of sales invoice, then copy of bill of lading or airway bill or railway receipt, or copy of bill of entry. For general average claim, counter guarantee or original cash deposits, then letter of subrogation duly stamped, a special power of attorney, loss overboard certificate, short landing or non-delivery of complete consignment. In cases of partial loss damage, the open assessment report by the carrier, then survey report of independent surveyor, and claim form and claim bill are required. Then comes the recovery in marine cases. Here there is a limitation of recovery in marine cases, and there is a provision of filing suit also for recovery from the transporters or carriers. In case of road, that is truck, 6 months from the date of knowledge of job, 6 months again in the railway case. Airlines case, 7 days from discovery of damage and 14 days from non-delivery. Port authorities, claims to be filed within 3 days. Mumbai Port Trust, 5 days. Calcutta Port Trust, and 5 days Chennai. Steamer agents within 3 days of discharge but before removal. And in case of damage not apparent, 3 days after removal. Limitations of filing suit is again different for all purposes. This is the case study of Bhavnagar, breakage of bridge, where the bridge were broken and the goods heavy loss was there. Type of loss, total loss. Cause of loss, bridge collapse, Bhavnagar, Gujarat. Type of cargo is showed 150 crore, weight of cargo more than 200 tons. Mode of transit 130 wheeler truck, 138 wheeler truck. Voyage from Mundra Port to Bhavnagar. Expected provision and loss 24 crore and expected loss 10 crores. Observations were whether the vehicle was licensed to carry the weight, whether there was any route map and prior intimation to the authorities about the transit being given, whether there was any supervision being conducted for loading, unloading, or the route followed, whether there was adequate packing done, like that. Thank you.